Hello fellow traders, welcome to one of the True Trading channel. This is another tutorial video on fundamental analysis. All profits go to my subs, so stay tuned, subscribe, like, leave a comment for the YouTube algorithm. Today, this will be a long video. Fundamental analysis is one of the most powerful tools while trading your entity, either as a stock, commodity, financial markets, everything you choose to trade. Analyzing and breaking down the impact of political, economical, social factors will give you an edge in your trading. In this episode, we will analyze all the aspects related to financial markets. However, I will cover the topic for people that are already interested in stocks trading. Of course, this channel is more related to Forex. However, I do have many messages from you. I have also received related to fundamental analysis. Keep in mind that we are a new channel, so actually, for sure, everything related to trading will be here. So I can guarantee that if you keep watching us, you will adapt some powerful habits that will make you a better trader. So, what is fundamental analysis? One of the three analyses that we are using in trading: technical, sentiment, and fundamental. I will drop a link as we have already analyzed the technical and the sentiment analysis, but today we will jump on fundamental analysis. So, first things first, what is fundamental analysis? A set of social, economic, and political factors that will and can affect the financial markets. We have the two major categories, quantitative and qualitative. However, in this series, we will analyze everything related to Forex market. So it's a set of indicators. Of course, I'm mentioning some economic indicators related to macroeconomy that will affect the currency exchange. Of course, we are talking about the long term. Some economic reports released related to countries' economic performance. So stay tuned. I will analyze all of them every time there is a significant event. Of course, I will also drop a link. Of course, this is up to you on how you will be able to informed about the news that are being released. There are some standard sites that we can visit. Of course, this is up to you because there are many out there. So let's give a look at each and one of the indicators separately. Interest rates decision, one of the most important factor that will affect your trading in the long term. The most important, of course, is Fed. They are usually do meetings. Of course, there are limitations. The higher the interest rates, the more they are affecting the currency, the stronger the currency will be. Why is that? Well, the logic behind is very simple. Of course, there are limitations, as I said. They are doing 8 times a year. But why the most important is the Fed, and why the USD is the most important? Well, it's very simple. Imagine that 87% of the daily currency that are circulated, it's USD. So everyone will follow them. Of course, there are some exceptions based on the currencies and based on the external policy. I will give an example of Bank of Japan. For the JPY, they want an underrated currency because they want to get some benefits from their exports. So most likely, and in most of their announcements, they are doing some dovish announcements. Of course, for people that doesn't know even this simple definition, every time they are making announcements, because they are the money movers, we have, let's say, some hawkish and some dovish announcements based on the definition and based on what they are saying. If they are more aggressive, the currency will significantly increase. If they are dovish, then the currency won't increase. And there are several examples. Of course, these are some major guidelines because, as I said, there are limitations. Now, how the interest rates affect your trading, and why you need to combine many factors. Of course, interest rates depends on inflation. Uh, for example, now that we have a high inflation, interest rates will keep increasing. However, this doesn't mean that you need to go long in the markets. Why? Because the market's already doing their adjustments, because we all already know that most likely Fed will increase the interest rates. So that's why we do not see so much increased volatility in the market when they are increasing their rates, because most likely we don't know exactly how in how many points they will increase their rates. Of course, remember of what I said, there are limitations. So keep that in mind. The one event should bring the other. And what I mean by that, we will also see the consumer price index, the CPI. When there is demand on the market, and this number increase, the figures increase, we will have inflation. Also, we might have inflation due to other factors. For example, the energy crisis is at the gates. So inflation will significantly increase, and the impact will be more obvious in the markets. I mean, the prices will tend to become higher. So the banks, the money movers, they must make a decision. They want to make money more expensive. This will keep the prices low, and that's why when we are entering a recession, of course, you are asking me if we are entering a recession now. No, I strongly disagree. Not yet. I don't know if we will see some numbers in a couple of months. Yet, in my opinion, we are good. So based on the increase of the interest rates, imagine that they are making the money more expensive. So investors most likely want to keep their money in the bank, because they will have some standard income based on interest. So you might see, for example, today, I don't know when you're watching this video, we see the S&P that is dropping significantly. Why? Because they keep increasing the interest rates, so investors most likely will keep their money in the bank. They will keep their money tight, so they won't follow, or they're not willing to invest. In my opinion, of course, every time you hear my opinion, this is the reason that crypto had that huge dive. Of course, the same for the stocks, tech, for everything. Imagine that we are exiting a COVID period, so high demand will follow, and of course that's why we are having also increased interest rates. I will leave a description. I will leave a link. Most of the major events I'm using either Forex Factory or MyFX book. These are the two sites that I'm watching. But you can find anything you want. You can make adjustments, and you can monitor the most important events. So for this case, interest rates is the most important in the long term. Also, how the major banks decides to consolidate power, either from their decision. Now we are watching the European Central Bank, because they cannot do much, and this is obvious in the long term. If you give a look at the Euro USD, you will see that there is a huge drop, a significantly huge drop. The reason is that they cannot handle the energy crisis, and of course they cannot handle the sanctions that they introduce. So they cannot do much about that. So we know that most likely we want to go short. That's why I told you it's very important to, when you are entering a trade, to know the fundamental, to know the environment. Also, there are currencies that are affected most likely from commodity prices, such as the Australian, the Aussie, the Canadian, and some other examples of currencies that affected much more from the commodity prices. Why? Because they are trying to hedge against the giant of the USD. So how they'll do it? Either by investing in gold and other commodities that will make their currency strong against other currency. So the important factor related to interest rates is that you need to follow Fed. everything they will do, everyone will follow them. If they will increase interest rates, most likely everyone else will do the same. Either is for the UK, for the England, either is any other country, most likely they will follow what they will do. So keep in mind that interest rates and Fed is the most important information that you need to know. As we said, banks are the money mover, so they have another important factor that can affect the local market, the monetary policy, the reserve requirements for the bank. So actually, I don't know if you're already familiar with that, but I hope you do. I mean, if you are trading, for sure you need to know some basics. When a bank gives a loan, it requires to have a percentage as reserves, and this is how the money is produced. This also produces inflation and so on. So based on the monetary policy, the higher the percentage, the lower the bank can circulate as the money supply in the market. The lower the percentage, the higher the amount of currency, the higher the amount of banknotes, let's say, the bank can circulate in the market. Of course, this is also dangerous because the lower the reserves that the bank has, the higher the bubble. What I mean by that, if the bubble explodes, then most of the loans and so on won't be able to be covered. Remember some huge and some major crises that we have, like the housing bubble. That's why I said there are some limitations, and for sure, based on this period that we are talking and we are making this analysis, I don't believe that Fed can keep increasing the interest rates. Why? Because they have a housing bubble. So they don't want this thing to explode. Inflation and interest rates goes together. By definition, prices and the level of prices will keep increasing. And that's why it's very important to keep a track on inflation, because based on inflation, most likely, and this is the rule, they will take decisions, and that will affect the interest rates. There is an inverse relationship between inflation and interest rates. The lower the inflation, we need to keep a higher interest rates. The lower the interest rates, the higher the inflation. Why? Because we are making the money cheap to acquire. So imagine that you can take a loan with lower interest. For companies also is very important. Why? Because their assets are keep devaluating in periods of high inflation. Of course, these are a more technical part that we won't analyze that, because remember that we are talking about the FX markets. However, companies' assets tends to devaluate in periods of high inflation. Of course, they are getting some back because their gross sales will be higher, but I think this is another topic. So inflation is another important factor. Keep a track also on consumer price index components. What is the consumer price index? Well, actually, it's an index on show how the strength of retailers increased or decreased. As long as they are increasing their consumption demands, this also bring higher inflation and interest rates and so on. So each and one of these components, that's why I've said that you need to have a strong analytical mind if you are willing to proceed in trading. Because I see some guys making some random lines in the technical part, which I also appreciate and I'm also using. However, is not the key that will help you with your trading, and this is why we are making this series, and we are going into depth every time we are analyzing everything that will help you with your trading. So there are some data based on the consumer price index, based on the country, based on the currency exchange, and based on what you want to analyze. Why it's important? Let's say that you see that you have a higher consumer price index for a period. It doesn't mean a lot, and it won't affect the market. However, if you are having the data and you'll see that the index is keep increasing, this means that will bring higher inflation, and higher inflation will increase interest rates, and the currency the banks increasing interest rates, the currency will be strengthened. That's why I say that dependently, and each and one of these factors can affect your trading. So for this part, this is how the consumer price index works. Also, there are many other indexes related to that based on the currency that you want to trade, either is the USD or the euro. This is one of the basics. GDP, the gross domestic product, one of the primary microeconomics indicator used to access conditions of a country's economy. It represents the total monetary value of all goods and services produced over a specific time of period. And why this number is important? When actually represents the size of the economy. So actually, for example, when you see that the GDP is increased by 3%, it means that the entire value of the economy has increased. Remember that these analyses are related to numbers, and you will also find some information related for each currency, and not for every currency these numbers are important. I will give an example. Let's say in the European Union, you don't care so much, let's say, for the GDP of a European country, that is not important. However, if Germany, for example, shows a higher GDP, this represents the entire Europe. So that's why it's important to not stay into one part of the analysis. Try to keep your mind more open, and find the most important factors. Or, for example, it doesn't matter how much it's increased for Spain, for example. Try to keep the most important information to help you with your trading. Retail sales. Release data covers sales during the preceding month, which means that this is a timely indicator showing not only the performance of retail trade in a given country, but also price level activity as a whole. For example, in the United States, consumer expenditure contribute almost 2/3 to the national total GDP figure. The report usually contains two components. Actually, you will see them as total sales, which is the figure related to a percentage, and there is a comparison with the prior month, X sales auto. Figure known as core retail sales. The higher the figure means the economy consume more. This will cause higher inflation. Higher inflation will increase interest rates, and so on. You need to understand the entire circle. Also, there are some more important based on the economy, based on the currency that you are trading. For example, some durable goods. That's why it's important when you are analyzing your markets to know exactly what is happening and what can affect your trading. In the end of the video, I will show you exactly what I mean, because I told you that it will be a long one. Unfortunately, we cannot miss the fundamental analysis from this series and from these episodes. In the end, I will show you exactly how to read the data and how you can put them all together. A very important factor for the economy, of course, it's the labor, the unemployment rates. Also, there are some rates related to employment. When you are analyzing the market, the most important figure once per month, every Friday, it's the non-farm payrolls. It's a very smart way to define the labor in the US. Remember that why we said the US data are the more important and how they can affect the entire trading. So each month, once per month, every Friday, you will see the figure of how many people, how many new jobs were created that were not related to land or farm. That's why non-farm payrolls are a very important figure. Also, imagine that as a very simple concept. In an economy, when the unemployment rates are low, most likely this economy shows some signs that will grow. Also important, other than unemployment, there are also employment rates. Actually, this has a more positive meaning. How many new people get employed? Also, to the opposite side, let's say, how many people apply and how many people were unemployed. Again, you don't have to be stressed so much. I know that these are too many information. However, if you want to have a head and an edge on your trading system, unfortunately, yes, you need to know many information. So that's why the labor and everything related to that is very important when you are choosing some currencies that you want to trade. Another important factor, the housing market, interest rates sensitivity, and how the housing data affects the currency, housing starts and building permit, existing home sales, pending home sales, new home sales. There are too many information, so you have to keep the basics in your mind and you have to structure it. It's a very simple way of thinking. When you see that in a country that you have more home sales, I mean, people are willing to buy new houses, then the economy is going well. Well, not necessarily. I mean, there is a small gap there. There is a small deadly secret for people that are not new in trading. You know exactly what I'm talking about. People are willing to buy things that they cannot afford it, and this creates the housing bubble. Of course, you cannot detect that. I strongly recommend to see The Big Short. If you haven't seen the movie, you can go back and see some details about that. However, it's important in your analysis to keep on track on how people are willing to buy and invest in new houses. Balance of trade. Actually, there are two major categories, let's say import and export. This will be shown by a figure, either positive or negative, based on the amount of the total services or good that each country managed to export or import. Now, it is important because of course, we have some countries that are rich in minerals and so on, so their economy is based on their exports. So the higher the value of their currency, this will decrease their exports. That's why I told you you need to pay attention to this kind of games. And the opposite. There are countries that are importing goods from them. They need raw materials to work because they have some strong manufacturing fields. And this is why important when you are analyzing a balancing figure, a trade of goods, the raw figure. You need also to pay attention in the country and if this country is based on imports or if it's based on exports. The PMI index is a composite index comprised of 5 sub-indexes, which usually correspond to surveys and encompassing more than 400 purchasing managers operating within the country. So they are chosen based on their geographic and industry diversification benefits. So we have a sentiment analysis from the purchasing manager based on these 5 sub-indexes. The most important part, there are 3 levels. Let's say if they're measured from 0 to 100. So a value of 100 shows for sure that the conditions were better. 50, the conditions were the same, and below, it means that the conditions are deteriorating. So what we are searching on this index, a reading above 50. This means that the industry, the sector is expanding. In case of manufacturing sector, is expecting overall economic activity, and it should be expecting as well. That's why the PMI index is considered as an indicator that then provides you clues also for the GDP levels in the future. I know that there are too many information in this video. However, we need to cover every single aspect. The Conference Board Research Group publishes this indicator, the consumer confidence, basis on a result of a survey encompassing almost 5,000 households in the United States. Participants are asked about the current and future market condition, economic condition, and work opportunities. But why this is important? We're actually the survey on a consumer survey on a consumer confidence belongs to the group of economic indicator which measure the financial confidence among consumers. The more confident they are about the economic condition, the more inclined they will be to spend money, which it turns stimulates the economy. Factory orders. Factory orders represents an economic indicator which consists of two separate indicators, durable and non-durable goods. You can maybe understand or you already know what I'm talking about. However, it makes sense. Non-durable goods includes items such as food, clothing, tobacco, and other products. Durable goods, on the other side, refers to some design products that will last 3 or more years. You can imagine what that might be, like car, buses, machine parts, airplanes, everything that will last longer. Now, this index is a bit underestimated because, of course, it's not so important. However, you can decipher it with the proper way, and you need to use it in your analysis. Of course, you can understand that the more orders we have, the better for the economy. Pay close attention to the banks. Banks are the policy maker, and especially the central banks. However, a central bank does not make a straightforward announcement because it does not yet know how the economy will react to its action. They don't want so much volatility in the market. That's why they need to pay attention when they are making some announcements and on how they will make the announcements, the interpretation of what they said, either if they are hawkish, either if they are dovish. There are some exceptions. I will mention incidents related with Fed. The president, it's very hawkish in announcements. He declares about increasing interest rates. He said that there will be blood and they will do everything that is necessary to keep their economy tight. So sometimes it's important to pay close attention on when they are making some announcements, and also because you are trading, you should expect high volatility in the market. Of course, remember that we are traders, so we need to stick to keep an eye on the big players. We want to follow them. Pay close attention to some major events, some war events, some major incidents that might affect your market. Of course, if we are talking about FX markets, not many events have a severe impact. However, most likely a war will affect your trading. I will mention now with what's happened with Ukraine. So most likely, due to the energy crisis, the oil prices will go higher. Remember that every time we are just speculating, we are not sure. So keep an eye on your trading, especially when you want to analyze your markets, because some technical and some sentiment analysis won't help you. Some random lines and some charts unfortunately won't provide you an insight on how to trade. Now we'll go to the last part. I've told you that it will be a big video. However, you need to find all the information that will help you with your trading. I have summarized all the information that you will need in the last part. For this, I will use my FX book. You can use Forex Factory. I don't have any benefit from them. However, their platform is much easier to use. As a drawdown, I think that they are a bit laggish when they are making the data. Anyway, I have gathered here the economic calendar because that's why I told you it's important to know what's happening and have some experience in your trading. This will come in time. I know that information are too many and you will need a lot of time and a lot of dedication if you want to make your account to be profitable, and this will take too much time. So this is how you will be able to see the data and how you will be able to interpret the data, decipher the data correctly. Here's the economic calendar. So I have opened the USD. However, you can open the one that you are interested. I have choose data with the highest impact because actually we are doing FX market. So this is most likely what we want to say. Now, if you check all the information that I told you, every single part, it's here. Either it's the PMI, the jobless claiming, jobless claims, non-farm payrolls, unemployment, market services, PMI, CPI, balance of trades, everything is here. So all the information that you will need, you can find them here. This is consists of 3 different parts. What was the previous data? What is the data that are expecting to be, and what were the actual data? Now there is a small catch here. There is a small tip that I will give you. The interpretation of the data. I will go to the non-farm payrolls of June. Now, the previous figure was 405k. Now, they were expecting to be 325. The data were 333. Now, what is why you need to be a good trader and understand the difference? So actually, what does this mean is that non-farm payrolls in comparison with the previous month were lower. It doesn't matter if the figure is better than expected because they will use these tricks. For example, better than expected or worse than expected. We are making an assumption, a speculation. Let's say I had the same conversation on Reddit with someone, with a trader for sure. So that's how they release the data. For example, let's say that you have an accident and you're expecting 1,000 people to die. So what you are doing, how you are changing the data, and you do it like this. You say, look guys, okay, we have an accident. We are expecting 3,000 people to be dead. So when the data release and when the data comes out, eventually you had, let's say, 1,000 dead people. So the data are better than expected. Well, the fact remains the same. You still have 1,000 dead people. However, you presented the data in such a way that they look better, or they will show some better numbers. This is also with unemployment, especially with non-farm, with the PMI, with the CPI, also related to housing, related to consumer index. All these small details you need to pay attention because this will make you a better trader. Also, not every single information has so big impact in the market. For example, we know that interest rates affect the markets very much. I mean, they increase volatility that day and so on. But when we are already expecting higher rates, for example, this period, then we don't have so much volatility. But imagine, I don't know if you are listening to my shows, some of you are traders already, so you will know that we had much higher interest rates. However, they didn't affect so much the market. Imagine that we are expecting, let's say, an increase of 0.25. but eventually you get a 0.75. So I mean, this is 3 times higher. Then you need to expect higher volatility. And also there are some surprisingly strange announcements. I do not recommend to trade while there are some important news out there. This is very important that you need to know. However, sometimes when our trade is open, we don't know the time and how long it will last. For sure, if you know your strategy, your technique, and the way that you are trading, you will be able to understand that there is a time related with your trading. So you know exactly, statistically, let's say, how many candles in a period your trade will last. This will come with experience. However, you are know based on the structure, based on the markets, the time frame that you choose to enter the trade, you choose to trigger the trade, you know how long it will last. Significant events will hit the market. My strong suggestion to you is prioritize the most important information: interest rates, non-farm payrolls. These are the important facts. Unemployment, for sure, unemployment, and try to check in each of these elements. Of course, the volatility in the market will be affected, but not so much. For example, the PMI won't affect the market so much. The best way to show this information that will affect your trading, it's by experience. This will make you significantly better trader. To know the news, to know if they have a high impact or a low impact in the market. There are some sites that will help you with that. Forex Factor is one, MyFXBook is the other one. There are many out there that you can choose what is better for you. You can customize it and check the most important events. And also keep in mind when you are the data are released. I mean, try to see the real value behind the value, because sometimes the data will be better than expected, worse than expected, as expected, and sometimes intentionally the interpretation of the data can be very different, especially in some major events. The latest one, let's say, I will refer to unemployment rate. We are constantly hear about recession coming and so on. However, this is not depicted in the numbers, not yet. Okay, for sure the S&P is dropping down because interest rates are increased, so investors want their money in the bank. No one can deny that, for sure. However, data and every time you are trading will make you better trader than everyone else, because you are able to analyze the data better than everyone else. And what I mean better, 9 out of 10 traders, maybe 11 out of 10 traders will have a different opinion. Remember that in the market, only 10% manages to stay profitable in the long term. You need to have, you have to increase your analytical skills. Again, thank you very much for your messages and your support. Thank you very much for subscribing to my channel. Most of you are traders. I mean, this is the best thing for me, to see people that are already know what they are doing to subscribing in my channel. I cannot answer to all your questions, like sometimes you are asking me like in what stock, what index and so on. I cannot be so specific, even though sometimes, yeah, you can get some of my trades. Again, you don't have to follow them. I know that this was a huge video, however, there is no easy way when you are trading, and I strongly recommend to check other videos also and some other sources because this will make you a better trader, significantly better trader. Thank you very much. Thank you for watching my series also. Remember, we are also having the Bitcoin series. This is why I don't want to trade the Bitcoin. There is no fundamental analysis. I mean, there are no numbers that will show you an increase or a decrease, and this is why for me it was a forbidden market in the beginning. Okay, most of you find a very attractive market. Okay, high volatility. Higher volatility brings more profits and so on. However, check what happened. I mean, it was 70k and now it's less than 20. Guys, thank you very much again for your support. Trade safe, and I hope I'll see you in the future.